Now, one of the first things my mentors taught me, they said, Steve, in order to be successful, you must always be in sync with whatever market you're trading. And I realized that I wasn't in sync. I was trading like 99.9% of all traders trade. I was trying to pick tops and bottoms. When I thought the market was way too high, or I read in some, we didn't have chat rooms or trading rooms back then, but we had like the newsletters when someone said, no, it's gone up, this market has gone up too far. It's never been this high before. You've got to short it. I would short it, and I would do the same thing on the buy side. If it's gone far too low, I would say that, the indicators are way oversold. You've got to purchase it. And I'm sure many of you trade the same way. And it would work for a few times, and I would think, boy, I'm finally on the road here. And then it wouldn't work at all, and I would give everything back. So my mentor said, Steve, that, remember, we're looking for consistency. We don't want methods that work great until they stop working. We want something that has this nice 2-step forward, 1-step back approach. And the way you get that is through being in sync. Now, the only trouble is that it's very difficult and it's very troublesome for many traders to figure out how to be in sync, because everyone has a different idea of what it means to be in sync with the market. But let's just kind of look at some examples here and see what most traders go through. For example, you can see this market here. We're in a sustained downward move, and then we start to move upward. So most traders, and myself included when I was trading this day, would say, well, you've got to buy around here on the bottom. It looks like we're going to be heading upward, so we've got to buy and try and catch the move up here before it goes too far up. And then look what would happen. It would go straight down. All right? Same thing works on the opposite side. You see a market go straight up. Perhaps some trading room or chat room you're in says, you've got to short this. It's hitting resistance. There's too much supply at this level, so you've got to sell. And look at this bar here. We close towards the low. So this is your point to sell before it comes all the way back down. So you jump in and sell, and then look what happens, okay? I'm sure this looks familiar to a lot of you. How could we alleviate this? How could we be in sync with the market when it's so difficult, when all these people are telling us, giving us different signals? There's too much supply. There's too much demand. There's a Fibonacci number here. There's, indicators are crossing over. Well, we came up with technique number one, and this is something you've heard me speak about all the time. It is simply the buy-sell line. Now, if there were one tool, if I were stranded on a desert island and I could only trade with one tool, it would be this. And I use this in everything. It doesn't matter what market I'm trading. It doesn't matter what time frame I'm trading. And the buy-sell line is simply the 50-period simple moving average. So I want you all to plot a 50-period simple moving average on whatever market, whatever time frame you're looking at. So I don't care if it's a 5-minute time frame, a 4-hour time frame, or a daily time frame. You should always have a 50-period simple moving average plotted. And what you want to do is ask yourself, if price is above that 50 period, then you will only be looking to buy, or in other words, you'll only be looking for buy signals. You're not going to just simply buy at the market, but you need a buy setup, okay? Either, something that is in your strategy or one of ours, but you can only look to buy if price is above. And conversely, if price is below, you can only look to sell. It's that simple. Once my mentors taught me this, everything fell into place. I was no longer trying to pick tops and bottoms. I was in sync with the market. And I'm not going to tell you that this works 100% of the time, but remember, we're not, going for that. There is absolutely no indicator or method that works 100% of the time. We're looking for consistency. And there is tremendous consistency with using the 50-period simple moving average. So let's look back at those charts. Remember, we wanted to buy here because this particular chat room told us that, or the trading room said, this is where you have to buy. It's going to bounce back up. And look what happened. Well, if we had added the 50-period simple moving average, we would have seen that price was below. And so if price is below, we have no business even buying anything. So you see how this would have kept you out of trouble. Now, on the other hand, we have this example right here where, let's say there was someone told you there was so much supply at these levels right here. As you can see, it was 1, 2, 3 times we came into these levels. So there's tremendous supply there according to our technique or indicators. And, you always, never want to go in the face of supply, so you should sell right there. So you would have sold, and look what would have happened. What happens with the supply? Now, supply is subjective. Supply and demand is very subjective. So it's difficult. We want something that's more cut and dry. And the thing that is cut and dry is the 50-period simple moving average. So all you need to do is plot the 50-period simple moving average, and you would have seen that price is above. So you wouldn't have even thought or considered going short. You would have just only looked for buy signals. So you see what a great tool this is. As I stated, I use this every day. It's not above my trading, even though I've been trading for nearly 40 years. This is something I continue to use and something that keeps me out of trouble and helps me be in sync. If you see here on a longer term chart, you can see the same thing happen. So if we're looking at a monthly chart, whatever market this is, we see that once price is above here, we're only looking to go long. And once we cross over and we go below it, we're only looking to go short. Okay? Remember, if you have any questions, I don't know if people came in late, please wait till the very end of class to ask questions. Okay? All right, so now let's look back at some Forex markets for last year, the best and some of the best and worst performers. So we're going to look at the euro yen, and we're also going to look at the Australian dollar and see how this technique number one, could have helped you with these two particular markets. We're going to look at weekly charts just so that we can encompass the entire chart, okay? So we can go back entirely from the beginning of 2013 to the end of 2013. Now, the euro yen had performance results of 27% from January to December. So that's great. I mean, this currency pair was up 27%, had a really nice and strong uptrend. Now, if we look at the chart here, we see that this is a weekly chart. Now, someone could have looked at this and said, well, we're going up, and it looks like we're curling over. So I think we're going to short it. Once again, there's some supply or some Fibonacci here that is resistance. So it's probably a good sell in the euro dollar in the first quarter of the year. So we should sell, but look what would have happened. Okay. So once again, you're out of sync. By trying to pick a top or a bottom, in this case a top, you would have been out of sync with the market. How could we have been in sync with the euro yen? For the entire year, we just simply add the 50 period simple moving average. And we see that price was above on this weekly time frame. So there's no way you would have lost money if you were looking at weekly charts, because you would have been in sync with the market. The only way you would have lost money is if you would have tried to short the euro yen. And if you use this simple tool, you will never have even considered shorting the euro yen. And so you've only had some very nice upward moves. How about the Australian dollar? Australian dollar was very poor performance this past year, down 22% from January to December. If we look at the chart here, we see that in the beginning of the year, the first quarter, we kind of had no real movement. We're kind of just going in a range here. Someone could have said, we're going to decide to buy this. Maybe it's going to break out of this range, and you look like we hit a bottom right here. Someone else could have said, oh, that's some Fibonacci number. You've got to purchase it because it hit the Fibonacci support and all these, indicators lined up. So let's say in some chat room, they told you to go long, and then look what happened. So how could we have stayed out of trouble on a weekly chart using our technique? Well, we simply add the 50 period simple moving average, and we see here that we had a little, oscillating above and below. But once we were consistently below here, there was no reason you would have ever considered going long the Australian dollar, and you would have missed all of this downward move. Remember, once again, because you want to be in sync with the market, that will give you that consistency. And the reason why we use a 50 period simple moving average is because it transfers over well into all markets. A lot of people like to use a larger time frame, a 200 period moving average. Some people like to use a 20. Some people like to use a Fibonacci numbers 34. The main point is that the 50 seems to transfer over well regardless of what time frame. So that's why we use a 50 period simple moving average. If you're looking at a 5-minute time frame, a 4-hour time frame, or a monthly time frame, it seems to work the best as opposed to all the different time frames. And remember, all we're looking for is to see where price is in relation to that. It's not some magical trading tool that will tell us when to buy and when to sell. It's just getting us on the right side. That's all we're trying to do. So if price is above, we're looking for buy setups. If price is below, we're only looking for sell setups.